All right, today we're diving deep into JD.com, one of China's absolute e-commerce giants. But listen, this is not your typical success story. Far from it. The company is at a major turning point, making this huge, incredibly risky pivot, and it has everyone, from Wall Street analysts to everyday investors, just holding their breath. So the big question we're going to tackle is, why? What's going on here?
And yeah, this right here is exactly why everyone's paying such close attention. I mean, look at this. While its big tech rivals, Alibaba and Baidu, have just been skyrocketing, JD.com's stock has absolutely tanked, down more than 27% in the last year. That's not just a bad year. It's a massive gap that screams something fundamental is shifting under the surface at this company. And if you're wondering what the experts think, well, the mood on Wall Street is pretty grim. This quote from an analyst at Morgan Stanley really says it all. The worst is not behind us. Wow, that is a chilling warning, right? It tells you that the problems JD is facing aren't just temporary hiccups. They're serious, deep-rooted issues that probably aren't going away anytime soon. Okay, so to make sense of all this, here's how we're going to break it down. We'll kick things off with JD's big paradox. Then we'll get into its unique, asset-heavy advantage. After that, a story of two numbers that just don't seem to add up. We'll cover the bull case and the bear case, and then we'll wrap up with a watch list for 2026, so you know exactly what to look for.
All right, first up, JD's big paradox. And really, this is the core of the whole issue. You've got this huge, dominant company that, on paper, should be absolutely crushing it. But, like we just saw with that stock chart, its performance is telling a very, very different story, a much more concerning one.
So, to really get why this paradox exists, you have to look at how the company is built from the ground up. And that brings us to its business model, what we're calling the asset-heavy advantage. This is the secret sauce that makes JD, well, JD. But here's the catch. It's also the source of its biggest strengths and its biggest weaknesses. So you might be asking, what on earth does asset-heavy even mean? Well, it's pretty straightforward. It means JD doesn't just have a website where other people sell stuff. No, they own pretty much the entire process. They buy the inventory themselves, they store it in their own giant warehouses, and they deliver it to your door with their own delivery guys. It gives them this incredible end-to-end control over everything. And this chart really puts it into perspective. Think about it in two camps. Over on the left, you have companies like JD.com and, Amazon. They're basically old-school retailers in a digital world. They control everything, from the warehouse shelf right to your front door. That's why they're so fast and reliable and why you trust them. Now, on the other side, you've got marketplaces like Temu or AliExpress. They're more like digital landlords, just connecting sellers with buyers and taking a cut. It's way cheaper to run, sure, but delivery can be slow, and quality, well, it can be a real gamble. JD's model costs a fortune, but that cost is what buys them their powerful moat.
Okay, so now that we get the model, let's see what it looks like in the financials. And this brings us to what I'm calling a story of two numbers, because this is where things get really interesting and, frankly, a little confusing. We have one number that looks fantastic, just screaming success, and another that's waving a massive red flag.
Let's start with the good news, and it is very good. By the end of 2025, JD had more than 700 million active customers over the year. Let that sink in for a second. 700 million. That's more than twice the entire population of the US. It's just a staggering number of people, and it proves beyond a doubt that their service is massively popular.
But then you see this, and it's a gut punch. Their profit margin has absolutely cratered. It's down to just 1.5%. That's from 3.6% just the year before. So for every $100 that comes in the door, they're only keeping about $1.50. So you've got this massive customer base, bigger than all of North America, and yet the company is barely profitable. How is that possible?
So that brings us to the million-dollar question, or in this case, the billion-dollar question. With all that revenue pouring in, where is all the money going?
And here's your answer. JD is going all in on some huge, really aggressive new projects. They are just pouring cash, we're talking billions, into two main areas, trying to crack the insanely competitive food delivery space and funding a massive expansion into Europe. These are incredibly expensive, long-term bets that are just eating up cash and absolutely destroying their profits in the short term. And that right there brings us to the bull case. See, the optimists, the bulls, they don't see these as just costs. They see them as vital investments into what will be the next big thing for the company. This is the argument for why this really painful period might actually be a brilliant move in the long run.
So the bull case pretty much rests on three main ideas. First, the stock itself looks cheap. I mean, it's trading at a price-to-earnings ratio way below its rivals like Alibaba and Pinduoduo, suggesting it could be undervalued. Second is that global push we mentioned. This is not a test run. They are going big in Europe with their Joybuy platform and a nearly €1.7 billion offer to take over the economy. And the third pillar? They're taking their biggest advantage, that world-class logistics network, and exporting it. They're literally trying to replicate their famous China speed delivery system with their own warehouses right there in Europe.
Okay, but of course, for every argument for, there's an argument against. And the bear case for JD is actually pretty straightforward and, frankly, scary. The big worry is that while JD is spending all this time and money trying to conquer the world, they're getting absolutely hammered in a brutal war right in their own backyard. You have to understand, the e-commerce market back home is a complete battlefield. You have rivals like Taobao and Pinduoduo, who are just masters of the price war. They run these massive, deep discount campaigns. And to stay in the game, JD has no choice but to fight fire with fire, which means pouring billions into their own subsidies, which, you guessed it, just crushes those already razor-thin profit margins.
So if you're a bear, your worries really boil down to these four things. First, that margin compression we keep talking about. It's bad. Second, all those new investments are just a massive cash drain, and there is absolutely no guarantee they will ever pay off. Third, they had a really strong year last year, which ironically makes it harder to show impressive growth now. And finally, there's always the looming threat of regulators in China stepping in and putting a stop to these platform-wide discount wars.
So there you have it. That's the big debate. A really high-risk but potentially high-reward strategy. So where do we go from here? Well, that brings us to our final part, your 2026 watch list. Instead of just guessing what might happen, I'm going to give you the key events to watch that will tell you if this big pivot is actually working.
All right, pull out your calendar. First up, the Q1 earnings release early in 2026. The only thing that matters there is the profit margin. Does it finally stop falling, or does the bleeding continue? Next, keep an eye out around the middle of the year for any news on that economy takeover in Europe. Getting that deal approved by regulators is a huge go or no-go moment for their global plans. And finally, in June, it's all about the 618 Shopping Festival. Think of it as China's Black Friday. It's going to be a real-time stress test of whether JD can actually compete in the price war at home.
And so at the end of the day, it all comes down to this one massive question. Is JD.com building the foundations of a future global empire? Or is this whole thing just a magnificent, incredibly expensive house of cards, one bad quarter away from collapsing? I guess we'll find out because 2026 is shaping up to be the year we get our answer.